The Supreme Court just rejected Trump's tariffs. Markets went up. Then Trump responded by announcing a 10% global tariff, and hours later, he raised it to 15%. So the real question is not politics. The real question is this bullish chaos or the beginning of a volatility trap? Stay with me, because what's happening right now could quietly reshape stocks, retail, and even your portfolio. The U.S. Supreme Court ruled 6-3 that President Trump exceeded his authority under the International Emergency Economic Powers Act. The majority opinion, written by Chief Justice John Roberts, said clearly, if Congress wanted to give the president tariff power under this law, it would have explicitly said so. The law lists many powers. Tariffs aren't one of them. But here's where it gets interesting. This does not eliminate Trump's ability to impose tariffs. It only removes one tool, IEP. Other tools still exist. Section 232, Section 301, Section 122, and within hours of the ruling, Trump announced a 10% global tariff under Section 122 of the Trade Act of 1974, then increased it to 15%. That escalation matters. After the ruling, the S&P 500 jumped 0.7%. Why would markets rise during tariff uncertainty? Because markets hate unpredictability more than bad news. When the court struck down the IEEPA tariffs, investors saw reduced legal overhang, possible refund of billions, lower immediate trade friction, short-term relief. But here's the psychological trap. Markets move on expectations, not headlines, and many investors already expected Trump to pivot to other tariff mechanisms. So the rally may reflect less worse than feared, not true optimism. Justice Brett Kavanaugh warned about something most people are ignoring. If tariffs are ruled invalid, the U.S. government may have to refund billions. Now think about that. Some importers already pass those costs to consumers. So who eats the loss? Government deficit risk increases. Administrative chaos increases. Corporate accounting uncertainty increases. This is not clean. This is messy. And markets don't price messy immediately. They price it slowly. Retail stocks initially popped. The retail ETF, SPDR S&P Retail ETF, moved higher. Because, tariffs hurt retailers directly. Take Nike, for example. Nike reported tariffs caused a $1.5 billion annualized hit. That's real money. Apple also reported a $1.4 billion tariff impact in its fiscal quarter. But here's the twist. If Trump replaces IEEPA tariffs with Section 301 or 232 tariffs, tariffs are still here. They're just legally repackaged. That's why analysts at Raymond James said investors should not assume tariffs disappear. They're shifting, not vanishing. Minneapolis Fed President Neil Kashkari warned this could create a, burst of uncertainty. And, uncertainty slows business decisions. Companies end up delaying hiring. Consumers, they delay spending. Investors hold off on allocation. That in turn creates a window of volatility. And honestly, volatility is where smart capital repositions, not panics. This moment, it's classic market psychology. So, Phase 1, shock headline. Phase 2, relief rally. Phase 3, policy escalation. Phase 4, confusion. Right now, we're somewhere between Phase 2 and Phase 3. The key question everyone's asking is, will new tariffs be broad and aggressive, or strategic and targeted? If they're broad, inflation risk comes right back. If targeted, it's more of a manageable pressure. Markets are currently betting on manageable. But, that assumption can change fast. Okay, so this isn't financial advice, but here's how professionals are thinking about it. If you believe tariffs escalate aggressively, then defensive sectors may outperform. If you think tariffs end up legally constrained, consumer discretionary could recover. The S&P 500 rally suggests investors see limited long-term damage. But rising bond yields? They tell a second story. The 10-year Treasury moved higher. That means inflation expectations aren't dead yet. So really, the trade here isn't about panic. It's about positioning for volatility. The Supreme Court tried to close one door. The administration, though, opened 3 more. This isn't the end of tariffs. It's actually the restructuring of them. And in markets, these restructuring phases can create the biggest opportunities, or honestly, the most expensive mistakes. The choice, well, it depends on how you read uncertainty.